So up 23% from the bottom in December. Here we are about to start earnings season, and we know that earnings are going to be down. The market has been fantastic at overlooking what's going to be a weak first half and looking at the second half. So if we start to hear companies report weak numbers and say they're bringing down guidance, that could be a little tricky. Now, we're up so much that even if the market were to come back in 5% or so, we're still having a year that's up over 10%. That's great, for the first 4 months of the year. So I'm not worried about that. And we don't really see interest rates going up. We don't have the fear of a recession particularly. And we're comfortable that the second half of the year will be better. The market can stay flat in here and get through these earnings. That would be a good outcome.
Yeah, get through the earnings, though, Josh. And listen, us, the financial media, every earnings season is the most important in years. But one does get the feeling that because of what happened in December and the bounce back that we've had, man, there's going to be a lot of focus on this one.
So one of the biggest traps that investors have fallen into in recent years is focusing on the overall earnings of the S&P and focusing on the S&P index and excluding in their thinking the stories at individual companies, the big ones. And that's been a huge trap, and it's probably cost people a lot of money. Because when you peel away, how much is the S&P going to earn this quarter? Is it down year over year? Is it down sequentially? When you skip all of that and just look at how is Google doing? How is JP Morgan doing? How about Disney? What about Nike? McDonald's? When you focus on the earnings stories of the biggest companies, what you see is just incredible growth. So that has been the key to being a winning investor in recent years, is to understand that while the overall market may not be gaining ground every quarter, year over year on earnings, the individual companies, the big ones, are doing incredibly well. Global companies, domestically focused companies, almost every sector, I can find you huge winners on an individual basis. And that has been the correct thing to focus on. So now let's take a look at the banks really quickly. The last time they reported earnings, JP Morgan gapped down 2% that day, and then it ended up closing plus 0.73%. You know what that tells you? Investors said they don't really care about current earnings. Take a look at Goldman Sachs. It jumped 9.5% the morning they reported their last quarter, and then has done nothing since. It's been consolidating. That gives you room for potential upside. Same story, Bank of America, up 7% that day, nothing since. This is very important that the financials participate in the market right now. They're 13% of the S&P, but they're 17% of the Russell 2000. And we want to see these companies do well, and I don't think you've got very big expectations on the part of investors. There will be, in my view, more upside surprises to come.